Lots of exciting things going on at 10 Capital these days. Can't wait to tell everybody about it. This week, we're going to talk about broken toes, babies, and the bond market. Excited to be back with you this week. Since I was last in front of the camera here, I broke my toe, much to the chagrin of my then pregnant wife, who was not looking forward to having yet one more child to have to take care of. My wife and I welcomed our second daughter into the world. Isla Grace was born last Friday. And of course, with getting that call only an hour or two before I would have shot this video last week, my colleague Jake Tim did a great job stepping in, helping explaining our planning process, and I hope you all took, as I'm sure you did, some great points away from that. We're going to talk about real quickly, hopefully here today, the bond market and put some context around this. Get a lot of questions on this. What are people afraid of? What should I be afraid of? Is there anything that I can do? And we're going to frame this up with the acronym FACE, facing down the bond market, facing down our bond fears. And really simply, that acronym is going to stand for the following four big points. The F, the Fed raising rates and that flattening yield curve. A, which is the alternative risks that bond investors have to navigate. C, the correlation to stocks and why anyone would invest in bonds. E, fourth and finally, employing experts and why we think it's especially critical when it comes to fixed income investing. So let's start off with that F, the Fed and flattening bond markets. So some common questions that I get or misunderstandings that I see. The Fed has been raising interest rates. Currently we sit at about 1.75. They alluded to this week that they would probably be hiking again in June. That would bring us up to 2%. A common misunderstanding that I see people have is that if the Fed's raising rates, then all other types of interest rates are going up too, from mortgage rates, treasury rates, bond rates, credit card rates, and that isn't necessarily the case. There is a strong correlation to the 2-year treasury yield, and why I'm mentioning that one in particular is that second part of our F, the flattening yield curve, and why, what is the big concern there? Why has flattening yield curve and inverting yield curve been making so much news? And what the heck is it? So an inverted yield curve is simply what people call it when the 2-year treasury yield gets above the 10-year. And why are they concerned about that? If the 2-year gets above the 10-year, in recent history, when you see that phenomenon occur, a recession is not too far behind. What's important to know right now is that the yield curve is not inverted. The 10-year is still about 0.5% above where the 2-year is. And a flattening yield curve is not an inverted yield curve. A flattening yield curve does not necessarily mean an inverted curve will occur. And so it's important to, again, wait and see if that occurs before anyone would make any decisions. The A, what are those alternative risks? When people talk about bond bubbles, what are they really talking about? Well, there are two types of bonds, if you will, associated with two types of risks. There are high quality bonds, people that have very high credit ratings, and there the primary risk is interest rates, because the only thing really that impacts the values of those up and down is if interest rates rise or fall. As interest rates rise, these bonds tend to drop the most in value, and the reason for that simply is that 4% interest rate that someone's willing to pay you isn't as attractive as if you can go out and get a 6% rate from someone of equal credit quality. The second type of risk is credit risk. And what we're talking about here, simply put, is not getting some or all of your money back. Why would anyone invest in these types of bonds? Well, they have less interest rate sensitivity. And why that is while interest rates might be going up, that's usually because economic conditions are improving. Their credit quality, that credit risk, is lessening, which offsets some of that interest rate risk. And again, we'll get to this in our fourth point, but expert bond managers can do a really great job tilting, navigating between these two to help bond investors get that yield that they're looking for without taking the full brunt of either one of those risks. C, correlation to stocks. And why the heck would anybody invest in bonds? So the short answer is it helps diversify away risk. If we think of 2001, 2002, 2008, stocks were down 10, 20, almost 40% respectively. And at the same time, the bond markets, those high quality bonds, were up anywhere from 5 to 10% and thus help offset a lot of those losses. If you're an accumulator, this is important because it helps you dollar cost average into that stock weakness, whether that's through the income that you collect or by selling the position in its entirety at a gain to then go average in to the stock market and buy down things while they're cheap. For people in the distribution phase, bonds, of course, play an important component because that income stream is something that you can help meet your living costs and give your stocks the time to ride through those difficult conditions without having to sell off some or certainly many of those positions to help supplement your day-to-day needs. So again, wherever you're at in your journey, it's quite possible that bonds can play an important component for you. Finally, the E, employing experts. Why is this so critical? Well, one of the big reasons is we don't think passive investing really makes sense in the fixed income space. Think about it this way, Apple gets to be 15% of the S&P 500 based on its merits, right? Its stock price is going up because it's earning a lot of money. That doesn't necessarily hold true with how you would construct a bond fund. And the easy example is looking at Japanese sovereign debt, government debt. It's been paying about 0% here over the last few years, but it makes up 17.5% of the sovereign debt market. So if you're going to use the same stock methodology of building indices and bring that into that bond indices, you'd go pick up 17.5% of your portfolio in Japanese debt that doesn't pay you anything with a country that has a 250% debt to GDP ratio and quickly shrinking demographics. That would be a bad call. And of course, this is why then, which is our second point of why we like to employ expert active managers, is they simply outperform with regularity in those more credit sensitive global bond type spaces. In summary, while the Fed has been raising rates and the yield curve has been flattening, the inverted yield curve has yet to make its appearance. And while bonds again we think can play an important role for all types of investors, using those experts to help navigate, relying on their ability to again craft a better bond portfolio than simply blindly buying a passive index, to us is the way to go. We hope this has been of help. We look forward to seeing you next week. Thanks so much.